5 days down. That's how many days we've seen the Dow and the transportational index decline. This is off the back of a squeeze that's occurring in tech and AI stocks and an incredibly high cost to hedge the markets. Yes, we know the debt ceiling's coming. We need to discuss it. We also know that OPEX is coming with trillions at stake this week. What an event. And stocks, commodities, and cryptos are showing us so many different pieces of the puzzle. Today, we explain central bank liquidity, where we're at, and why we need to be cautious right now in markets, but keep an open mind. Well, welcome back everyone to The Daily Show, where we talk about markets around the world. This is our special weekend edition where we're discussing the macro, the news, the lead indicators, and of course, the hottest charts for the week. If it's your first time here, welcome to the community. Subscribe, smash that like button. I'm sure you're going to find a lot of value in today's video. So at first glance, this chart might look crazy, but really what it's doing is it's showing you divergence between central bank liquidity, being this purple line, and the market itself. The further this gets apart, the more worried you've got to be about the upside risks. And we know this because if you look at this purple chart, it's really driven a lot of 2022 back end into the 2023 run so far. It could be the most important chart to be watching on the markets. And we'll come back to this a little bit later on. But straight away, I want to answer a pretty simple question here. There is something to do with the Dow Jones, which is here 5 days down, and the transportation index, which has also been declining for basically 5 days, that we need to discuss. This is a very rare statistic. In fact, it hasn't happened that many times over the last decade. And I'll give you 2 points when it has happened. One is July of 2011, interesting. And the other one is, of course, February of 2020. In both cases, what actually happened with the markets was they drove higher and then they fell quite significantly. So we have to be aware that the Dow Jones and both the transportation index are showing us something very strange. And that brings us to the Skew. Now, some people will be familiar with the Skew. Some people don't like it. Some people use it. I think it's a good time to be bringing this onto your charts and paying attention to it. If we take a look at some of these other dates, the 28th of March, 2022, well, you'd all be familiar with what happens in April. We drive higher and then we dumped off. What happens with the Skew? It drops beforehand. If we go to other dates, August, around the 16th of August, we see a drop in the markets. You can see here the Skew drops with the market, if not slightly before it. I think we topped off on the 16th. And if we look at 2023 so far, what do we all see together? Well, the Skew just keeps driving up. Basically, we're seeing tail end risks jump in a massive case. Now, the Skew has not been good at predicting black swan events. That's technically what it's meant to be doing. But what it is going to show us is that we are seeing puts at an incredible cost right now, considering the implied volatility in the market. We're actually being suppressed. The market is being suppressed due to the amount of VIX calls that are sitting out there. So the Skew has become something that I would put on the charts. And what we're looking for this week is a decline in the Skew and ideally a market either to be hovering in the range zone or to be driving higher. Now, if that is occurring, it's a great sign along with this central bank liquidity to break down the markets in a more statistical data form, which is something we like to do here in the markets. What about implied volatility of the bonds market versus the VIX? Well, we've looked at this many times now over the last couple of months, and it's constantly been telling us that there is a huge discrepancy between what the bonds market believes is risky at this stage and the stock market. The VIX is being suppressed. The bonds market saying, well, we still think there's a lot of concerns. And this gap is pretty large. In fact, you're starting to see it with corporates as well. This blue line here is corporate bonds, inflation adjusted. And this red line or this orange line here is the S&P 500. Now, what we're seeing is the S&P 500 is still technically driving higher with higher peaks and higher troughs. However, the bonds market, corporate grade bonds, are starting to drive lower with lower peaks and lower troughs. If this continues to be a divergence, I know who I usually trust on the midterm. And I'm telling you, it is never the stock market. I never trust the stock market. I generally trust the bonds traders. They're looking at the real risks to the companies, whereas the stock market is all about the profit, the fear and the greed and all of those types of things. If you haven't already, consider jumping over onto our Twitter, links in the description down below, joining us over on Twitter. I'm posting there, of course, all of the biggest options weekly events. 68% of the time, the market will stay within these ranges. They're great to have on your charts as further confluence towards what the market is doing. You can see I post a whole bunch of other things, but I did just want to point out the CD swap rate here for anything to do with United States treasuries. Basically, we are seeing a real potential of people considering that there is a default coming on the US markets. Now, of course, I don't believe that, but debt ceiling events have historically been some volatile, some not. This one's shaping up to be probably an excuse more than a real reason. There are many reasons why markets could fall, but people are hedging hard into the debt ceiling. And we can see that when we take a look at some VIX calls in just a second. What about sentiment? It still came in bearish. I told you I'd update you on this one, as well as the biggest flows in the world. So we'll look at the flows in a minute. But we're sitting about 41.2% as of last Tuesday, bearish in the market from retail traders, 29.4% neutral, and 29.4% bullish. We really need bullish to return back into the 30s to even 35 plus for us to really consider that the bears could be kind of sniffing around. And that's going to be an important one. Sentiment is part of the storyline, part of the confluence. If everybody in retail is starting to get, super bullish, often you'll see that being a sign of where you should be contrarian. And at this stage, it's so neutral. So many people are switching, of course, their midterm views. The more that happens, the more we drive into resistances, the more we need to be paying attention. So hedging against the VIX is ridiculous. You can see here how high it is. It is massive, and it is suppressing the VIX. Basically, the amount of calls on open are huge, and this is because people are buying them. They're buying hedge protection into the debt ceiling. At the same time, we're not really seeing any outflows from the biggest traders. We're not seeing this blue line decline. If this does decline, I'll be the first to update you, so make sure you subscribe to the channel. But this shows us basically the largest fund managers. So fund managers have been buying, not in extreme quantities, but obviously bigger than they were purchasing at the bottom end of last year. And you can really see, we bottomed in October. Obviously, they started to increase their pricing, and they've remained, I would say, relatively neutral in their positive bets this year. It's kind of like saying if you had a 60-40 portfolio, 40% is in cash and bonds at the moment, maybe even upwards of 50% for these guys, and 50% is driving into the market. So they're hedging their bets, just like everybody is, on whether the next move is actually bullish and we're out of a bear bust, or whether we're going into a recession. Here's our update on gold. Stagnant. No sideways action for sure. We saw the rejection. I warned against this over the last couple of weeks. A lot of people gave me a bit of flack of it. I still think we're in a trade range here for gold, if not into a downward potential area here. It's very important to see what the Fed does next before you make your next gold move. Do I still think gold goes up to $3,000 over the next coming years? Yeah, I do actually. But I just think that you've got to be careful of this trade range. We were very bullish on it. Now we're neutralized. We're waiting to see more. If this chart starts to go down, again, we'll first update you here. It will show in price action first, but when the big guys go out, rallies should be faded. That's kind of the way we have to look at it. Same for the stock market one. Smart money versus dumb money. I'm just going to say question mark. Absolutely no edge on this chart at this stage. We saw that, of course, smart money was declining their purchases through this. Then we've seen dumps. We've seen them purchase a little bit on the dump lows, which is what's happened here. And realistically, it's just completely neutralized at this stage. Now, I want to bring this to our attention. If you're an investor that watches this channel, or even a midterm kind of bigger swings guy, I think we need to be aware the word recession is obviously cooked, and people are probably moving away from it because of the hate, no doubt, that gets put on it. We've already seen a recession. Yeah, technically we did last year. Therefore, it doesn't matter. But we do need to be aware of equity risk premium, and also that actually here's a stat for you. The S&P saw drawdowns of over 20% in 7 of the last 8 recessions, and in almost all of the recessions since 1929, most of the max drawdowns, 67%, took place during the actual recession and not in the prior 12 months, okay? So it's very important that we look at that. Now, here's where the stat is. If you believe we already went into the recession last year and that was what it was, technically you could, because of course they changed the rules on it, then we may have already driven this. However, if you believe there is actually a real recession coming back forward, then it could still be that 67% of the drops were happening. And of course, S&P 500 generally made a low during the recessionary period, not before. NASDAQ, however, didn't always. NASDAQ is always the one that bottoms first, drives us out, consumer discretionary next, and then, of course, a lot of other sectors. I wouldn't be FOMOing the market right now personally. It's my personal opinion, because I think there are lots of sector rotations that you can occur to go jump into that are still incredibly depressed if you believe we are going into a bull market. Big tech, yeah, sure, that's gone. However, there's still Google and Amazon, as we pointed out last week, that are already on runs. And then there are, of course, so many other sectors. So never feel too scared in these markets. There's always opportunity. Here's the old Fed dot plot, and I'm just bringing it up for the reason that is this simple. If you are a bear in the markets, you need the Fed to hold the line. They usually pause between 4 to 6 months. They do not cut. The market believes a cut's coming. The Fed's dot plot this month will be very interesting. We'll get that soon, so we'll find out what's going on. S&P 500 forward PE, also something to consider here if you're a long-term investor. Remember, I like to invest underneath the averages, not above it. That's just my personal opinion. And at the moment, we're trading at about 18.6. Not usually the time that I like the market so much. Let's move over to sector rotation, what we're all about here on the markets and the channel. And it's been 5 days of gold getting ripped to the downside. And of course, we've also got these regional banks going into very negative territory, but they hit some levels that we'll talk about later on today's video that I think is quite exciting if you are a very high risk taker, I guess, out there in the markets. Agriculture and energy also falling over the last 5 days. I'm going to give that a big tick. That's exactly in line with the stats that were very damning on these sectors moving forward over the next coming months. We've seen some serious stats coming out over those. Not those ones that are like 60-40, 50-50. They were like 30-26, terrible looking things. We also know that over the last 5 days, we've seen consumer discretionary be one of the best, communications, and a bunch of staples starting to come through again. We are going to have to watch our eyes on these defensive sectors, because if defensive sectors are running the market and they're the ones leading, usually means Wall Street is bunkering down. And we've used that very effectively to show dumps coming. So remember, we'll be paying a lot of attention to that, especially into this week's OPEX big event with, of course, everything to do with the options expiration. When we move over here, you can see the dailies and what's going on. But I want to look at the 3-month. Look at the discrepancy here. We've got regional banks, financials, and the market's all good. It's all good, guys. We're being supported by central bank liquidity. Very weird. You know, financials and energy, this is a huge discrepancy. I don't think I've ever seen such a big discrepancy. Something to, look at, obviously not necessarily be scared of, but this is the rotation of the last 3 months. So like we've mentioned, defensive's actually still doing very well in this run. Yes, I know technology's done better. And then, of course, gold is still the standout. And it had a great GDX breakout a few weeks ago. Well, actually, it's all been pretty much this year's been pretty good on gold. And then gold now is possibly in the stagnation point. Though I would say that gold stocks are underpriced to gold spot. And I think that's very important. Gold stocks are still cheaper than the spot itself. So just before we jump into the charts and we take a look at all of the key levels that we should be watching right now, I want to say a big thank you and shout out to Tiger Brokers, who are the sponsor of today's video. Now, you all know that I love Microsoft, and I think it's one of the strongest AI plays that we can see on the horizon. But on top of that, we also know that Tiger Brokers have taken account for this. And for the Australian viewers out there, if you're interested in opening a Tiger Brokers account with as little as 1 cent funding, you'll get an additional Microsoft amount of shares. If you fund with as little as 1,500 over the first 7 days of opening, you'll get an additional 30. Now, why are some of the reasons why I like the Tiger Brokers platform? Well, it has to do with customization. And I think in this day and age of so much information out there, you want to be able to customize and really kind of get into a modular feel of some of the things that you're looking for. For example, let's say you had Tesla up and you wanted to know everything about Tesla options, Tesla volume profiles, Tesla news, or anything else. You could do so by creating your own custom workspace. And you can do it as simple as going to the general toolbox here, adding the sections that you want, and then customizing each one of those. You'll also notice that because we live in a worldwide market nowadays, it's great to know different times around the world. Specifically, of course, New York. You always want to know York, London, those types of times, so they are there. One of the upgrades that Tiger Brokers has bought recently has been to its live news feed with constant refreshes going on and more premium feeds. If you wanted to get a premium feed like Reuters, it's there in the platform. So what are you waiting for? Check them out in the links down in the description down below. And of course, they've got a great application for, of course, iPhones, Android devices. All right, let's jump into more charts here and start looking at some big things. Consumer discretionary, are we broken out? Have we actually seen an increase? Well, of course, when we're looking at the stocks market, you can see here it's a compelling case when you look at it going, oh, wow, I think a breakout's coming. No breakout last week, but we did get some very nice stock moves. Google in particular moved all the way into the first take profit within like 2 days. Let's move over to copper. This one did decline and it moved into our first TP zone. Now, copper, or Dr. Copper as they talk about it as, can be a precursor to problems in the worldwide economy. So we need to be careful of this one. It often shows that China is weakening as well. Which we already saw in stats is kind of the way that we're looking at it. Again, China, one of our old videos last week had a whole bunch of 30 and 40% stats towards its market. If we take a look at this though, we're looking for breakouts down below. I'm not positive on copper. I still think it's going to weaken, and we are looking for a low underneath this point. So maybe a rally into a low break. And of course, if copper keeps breaking low, then that's just another precursor that we could be in a market that is totally on false pretenses. And I still think on the midterm, we are more likely than not to see some weakness coming through in the markets once we expire some of these puts and once we get rid of these ridiculous VIX calls that are everywhere right now into this debt ceiling discussion. HYG, here's the high yield debt junk bonds. They were down, market was down. That's pretty much in line. No big discrepancies here, but we do watch it. We also know the US 10-year is still hovering above 3.3, so no news on yields themselves. Let's move over to the dollar though. Whoa, dollar came through big time, and I mean big time. Look at this weekly. So I've obviously been negative on the dollar, but this weekly is as a big sign towards, okay, well, now we can start to look for some relief rallies. I think, with everything that goes on the dollar, I did warn against it. I wasn't a big fan of taking too many dollar trades. However, the private community and I were looking at pounds. There's a great short last week, amazing short actually. And that's what I really was looking for. I didn't want to trade the dollar itself. I wanted to trade other currencies versus it, and more that were cleaner and clearer. And if you look at this, obviously it was just so many weeks down. We've based around here, and then we see this huge closure on the highs. That usually shows that pullbacks should be met by buy demand. And I'm wondering whether the dollar is able to get back up into this 104 area. This area here provides a lot of confluence for effectively shorts. And I think that's a big zone that's going to come through. Because of the closure on the high, generally speaking, pullback should be met by buy demand, and I'm looking for this zone here. So I'm going to be very patient on the dollar. I could see it retracing a little bit here. First targets or targets that I could see move forward, 102.76 zone. I could see the market kind of going like this, and then potentially like that. And if you actually put a fib on the chart, so let's just do that. Let's put a fib from this low here to this high here. You can see it kind of jumps in there. But if we go to the high, it starts to bring a much more compelling story that this area here brings the bulls. So I'd kind of like to see this at this stage. That's the way we're looking at it. That weekly close is significant though. It reminds me a lot of what we had over here, except that the dollar didn't make a new low. If that made a new low, oh wow, this thing would have been flying. And yeah, it's just all in those little nuanced plays. It didn't quite take the bottom. That's interesting point. Gold traders that went short, well done to you. Very nice. Certainly a fantastic kind of little play there. Now with gold, the way it's kind of shaped up here into the weekend, I kind of see a little bit of base support here. Possibly gold could move higher. If it makes a new low though, I would think back down to the most traded zone, 1983. So if we breach underneath 2,000 an ounce, I would say we're going to 1983. At this stage, I could see buyers for gold pushing back higher and getting back into that 2030, then potentially dropping off. And if we look at the weekly, it's not a strong story for gold. You can see here the weekly, big rejection, lots of wicks. I like to think wicks hold orders, and they definitely in this case seem to be holding supply. Somebody's dumping this gold, and I don't know who it is. We're not seeing it in the big flows yet, and that's something that we'll need to be paying attention. If we saw this in big flows and big flows were dropping, and at the same time we saw that, rallies dump. That's the way we'd be looking at it. We will keep updating you guys. Subscribe, smash that like button for this stuff. It's going to be I think it's going to be damn good. All right, let's move over to oil and we'll check that one out. Still looking pretty bad. Nothing good about oil. You know I hate oil at the moment. Demand destruction is in play, in my opinion. We have a most traded zone that markets could rally to and then potentially sell off from. We didn't quite get our red box last week on the sell. We got a smaller introduction to the short, and I kind of feel like oil will continue its downward spiral at this stage, and then that's driving into stocks, which has been where some of my bigger bear kind of stories have been. Metals and oil have been something that I've been very negative on, and I still think that there's more in these trades. We are starting to come up to a period where over the next maybe week we probably should drive, but I could see something like this occurring. And I think there'll be other opportunities for people if they want to get involved in demand destruction. But yeah, oil still looks pretty weak. We obviously found some level of support here at 77.93. Breach underneath that, well, it's pretty clear it's going to 76. And then if we end up going underneath 76, then we're probably driving into 68.70, which would be a pretty good target for what I'm kind of looking for here. Energy still looks weak, so do metals at this point. Now, let's have a look here at Tesla. I'm going to update now the two levels for this week, but look at that. It hit that expected options weekly high and just sold straight off. It got some gap fills, but didn't quite get the real gap fills that I would have liked. Now, of course, I'm definitely on the record of saying that at this point here, I was bullish on Tesla up until these zones in here. We end up getting a big weakness. Be interesting to see how the NASDAQ drives this week, whether it drives down or up, but Tesla did technically hit this zone. It hit this. I don't consider that a gap fill. So still the gap fill is not completed. New options expected, weekly options highs and lows aren't that different. So we've basically got 175. If you want to get it correct, it'd be 64. For the video, we'll just do 65 because I can get that easily. And on the bottom, it'd be 160.32. So we'll just do there 31. We'll be fine. So we've still got a trapped range. We could see something like this occur. Not a great Friday for it, was it? It was a pretty decent sell-off into the close. Still in the downtrend. Obviously, we're still driving towards 145. Very tough. We'll have to keep looking at these lows, see how they're triggered off. If you get kind of like a drop, and then by the end of the session, you've pulled that back up and you've held it, there's a good chance we keep snapping higher into the 180s. If we get a drop, though, and we close underneath, it's probably going back to 145. And this remains my still very big target on Tesla for the shorts. But I still think that it's still open both ways. And the problem is it's going to be all about the reactions in here. You got to be very careful. Big week. We'll actually even look at max pain here. And what we'll do is we'll refresh and look at the 19th. So you can see here the 180 calls. Maybe it's too much for it. 180 calls, 51,000. 160 puts, 35,000. It might be a good point for the market to actually still consider itself range bound here. Drive maybe higher initially, then drop. 2 days this week, which is I think Wednesday and Thursday. Wednesday and Thursday, they're actually statistically 60% plus bearish days. So if you took all of the history of the last kind of 25 plus years, you would find that those are the bearish days. It's just slightly bullish as well on the Monday and the Tuesdays. So the stats for this particular week aren't that great towards huge rallies in the markets. Monday, Tuesday would be more the rally days. Wednesday, Thursday would be more the sell-off days, into especially the third week options expiration. And then Fridays, maybe a non-event, we'll find out. Disney, actually interesting level for investors. I mean, it fell a lot. It's back down in this zone. I'm going to keep watching it. I'll set some alerts for you guys, and we'll keep having a look at that stock. Google, we reported on the breakout. This was a pretty phenomenal trade. Continues to slingshot. It's hit a pretty good take profit, in my opinion, which is this first line. I call it the problem zone. It's basically the high of a lot of traded volume. And we know that then we've got these highs up here, which probably hold a bunch of short stop losses. So I could see a stop loss hunt here. Google keeps driving 123. That would work with the skew as well. What if it drove like this? Skew drops off. This is the one I'm looking for. I'm looking for some signs of counter, not just the central bank liquidity, which definitely breaks a great point for the market to short soon. But it's hard to get through when you've got so many damn puts floating around, which we'll look at in a minute. KRE, this is regional banks. They look like they've come into the zone where we could consider that buyers may be committed. It's very important KRE holds a zone like this. Basically, we saw what we would call a squeeze event, a dump into that squeeze event, and now is decision time. This is the area where if KRE is going to find buyers, generally it will, because it's pulled back to the right kind of levels for us to see that. What about Apple? We're watching this like a hawk over the next 2 weeks. I mean hawk-like. We are all over this one. And the reason we are is because we need to be very aware of how Apple reacts to these highs, if it does drive there, how it looks on the price action, and whether it's giving us an inkling of trapped retail traders. You'll notice here we have, after the earnings, a gap up market here. If the markets come in one day, they gap down, what's that? Island reversal. Where is it? Big red zone. So we're very much all over Apple as a bit of a trapper. We have not seen weakness. We obviously have seen only a series of peaks and troughs. We're guessing that could happen, but that's what you're doing here. You've got patience, you're reacting to the market, and we're just coming up with chess ideas. We're not necessarily predicting, we're just coming up with different solutions for the market. DAX, mediocrity, still stuck inside the range. Don't really know what to think about it. Is it accumulation? Is it distribution? It looks like distribution at this stage, but we don't have just enough evidence at this point, so it's not going to help us. XJO, copper. Depends how copper will end up playing out. If copper weakens again, XJO will fall. I'm not bullish on the Australian stock market at this stage, though, so we'll keep updating, but nothing much to report there on the weekly for the Aussies. IWM, let's get into the stock market in the US. This market is pretty well trapped. 175.64 is the top end, and the bottom end at this week is 169.32. So really, we're just sitting right on the same levels as we did last week, pretty much. We're in the middle of the zone, long leg dojis, all sorts of things, equilibrium. It's a bit of a boring market. Very hard to trade the Russell at this point. We've had great short zones in the past. At this stage, just looks weak. But I'm open to both ends here on the Russell. I think it'll provide some good opportunities. And in our next video, what we'll do is break down the Russell 2000 into some components. So once we take out the regional banks, we can see actually the health of potentially the growth stocks behind the back end. Let's look at the Qs now. Now, this is where things get interesting. There is a great discrepancy in the force. And I mean, it's pretty big. Central bank liquidity is nowhere near where it needs to be for this kind of run to be happening. And I think this is the biggest discrepancy we have from central banks. Now, you can see when you get great buy zones, oh my God, yeah, cool, nice. But we're starting to get into the point where we are deep, deep red in terms of divergence. And that means that as we drive higher, the risks, as long as this line keeps going down, the risks start piling. And I just think people need to be aware of this. Druckenmiller said it in a recent interview, you've got to keep an open mind here in the situation. Yes, of course, my midterm is still bearish. Yes, I still think we're going to recession. Yes, I still think markets will drive lower at some point, though maybe not the tech. That may drive not as low as we think. My favorites, Microsoft, possibly Nvidia will drive lower, but maybe not as much as some people would want. I don't know if you're going to get new lows on those, but the stock market itself could become quite sick. And I think we need to be aware of that in these markets here. Let's look at the US 100. This is an interesting point. Now, we want to still watch this reaction around this 13,220. I actually think that's an interesting zone. The markets drove higher. Then they gave a little reversal last week but they're still in the middle of the nowhere land. So to short here would be weird, actually. It would be a weird time for it to short. So it drove higher near the close. Not much to go off there. Watching reaction in this block here to see if buyers recommit, which would be a good level for them to do so. And if the markets keep driving down, some key levels to watch this week, 13,000 on the NASDAQ. This level here, which will sit around 13,100 and kind of 50 all the way to 13,200. That's going to be a big zone if buyers do commit there. For shorters, you're going to look around this level here as a day trade, 13,000 kind of 380 to 400. That's where you want to see shorts recommence if you believe it's the turn. And on the weekly, you can see here it's still held up, but wicks both ways. So it still looks bullish. It broke all those highs off a few weeks ago, And at that point, generally, you're looking for it to drive higher into this huge red zone up here. So I guess that's what we're looking for on the NASDAQ, which is a bit different to the SPY. The SPY is sitting right on its daily 20 moving average. Boring. That's literally sitting on mean reversion. So it's really boring. It's trapped within a range. Really boring. You could make island reversal statements towards the bull end. You could make false break statements towards the bear end. At this stage, I'm kind of thinking one of the distinct possibilities based on this Friday is still a drive like that, where it doesn't quite breach this top end range we've talked about before, like 42.20, and we're actually still seeing, we see that. And if that happened and then it went down, well, that's a UTAD or a UT. Wyckoff's distribution's full in place. So there's a lot of scenarios we can play out. Let's have a look at the futures market. So we'll get rid of this for a second here, and we'll look at the futures market. It held 4,100 again. 4,100, big level. We know 4,100 breach could expose us back down to the 4060s, and this would be an interesting level to see whether the bulls or bears win. Whoever wins here, big deal, as we know. Heavy traded zone, super boring. And we keep coming back to this equilibrium, and we can see why, because these VIX calls are everywhere, the puts are everywhere, everything's everywhere. So we're still trapped inside the range. These are the buy zones, these are the sell zones, until pretty much proven otherwise. There's nothing much we can do. Now, because it's testing from the bottom up, generally the middle zone or the equilibrium zone is where you can see sellers recommence. And if they did that, then they'd have a lower peak and then they breach low. Then we'd probably go down to 40.60. I think we're going to have to play a lot of chess on this, and I'm looking for the Monday action to actually show us something more. It's very tough in here, and you can see on the daily, it's so trapped. Even the closure points, they're all very similar to each other, which means you're even more compressed inside of the real body of heavy trade, which we know. So very, very tough market here on the S&P. I don't think we have direction just yet. All right, well, let's take a look at Bitcoin. So, of course, I've been talking about 26,500. A break close below would expose us to 24,000 move, and we didn't quite get it. And I want to go down to the smaller time frames. Well, first, let's just look at it on weekly. So a lot of people are going to look at this. They're going to say, oh, that looks bad. It certainly does. And if we go to the daily, you can see here the closure didn't get underneath. It actually rebounded straight back up. So let's go to the 2 hour and understand this move a little bit better. Now, first up, this is an important area for the markets. The markets dropped, it sat, it got smashed, and then it came back up and it's holding it. It's important that bears basically sell this direct zone we're at right now. Bears should sell around here. Obviously, they should hold these highs, and then they should look towards movements down. I wouldn't discount bulls trying to recommence somewhere around 26,200, which will be an interesting point for day traders. So day traders shorts, day traders potentially long. If we then drive for a daily close below, we should be going to 24.2. Now, some people believe that Bitcoin is a precursor to the markets in terms of risk, and it has kind of been recently. So Bitcoin, precarious for sure, not underneath the level yet. Very good day trade style scenarios in both cases, and we'll have to find out how that ends up playing. Let's have a look at the options for the big week ahead here, and we'll go over to the 19th options expiration. Look at the 400 puts. They're everywhere. I mean, it is very unlikely the market can drive underneath 400 this week. Not impossible, unlikely. So that's not going to probably happen. You would think 405 is max pain, so we'll see how that ends up playing out. Lots of calls on the top end. I think they lose. So bad luck for them. Sad face for them. Sad face for them. The market's done a great job over the last year of extracting a ton of options money. So somewhere between kind of like 420 and 400 is your expected range for the options market itself. Obviously, we have those expected range 68% of the times as well. But we'll have to just see. This week could be literally very boring, but the data stats on Wednesday and Thursday are historically bearish. So we'll find out whether that does occur. Let's move over to the news. Empire State Manufacturing Index, 8:30 a.m. New York time, guys. So watch out for that one. Then we come down to core retail sales, 8:30 a.m. And then we keep scrolling through, and you'll notice we get unemployment claims on Thursday, May 18th. And then Fed Chair, the Powell, he's coming out 11 a.m. to annoy us on Friday, probably, and all the rest of them. Look at them all. FOMC, Williams, Bowman, Powell. Oh, it's going to be like the G7 fest. So anyway, this is a big thing. This is what we're looking at. Massive options expiration week. If you're interested in following us through some of the other socials as well, you can do so. Links in the description down below. I really encourage you to take a look at everything we've got, including some free cheat sheets and our Twitter. And of course, if you want to support the channel and you're interested in a couple of special offers, check out the links from Tiger Brokers, the sponsor of today's video. Thanks so much. You have a great weekend. Bye for now.